Hello, my name is Manny Kagan. I'm founder of Money Solutions Academy. A very special guest, Tammy Blanchard. I know her. How many years we know each other?
7 or 8 years, maybe
Only?
longer.
No, longer.
Has it been longer?
I
It's
think
been
it
a long
was, yeah,
time.
probably longer. You just, your mind start and
Well,
yeah,
I've
compressing.
lost some time the
Oh,
last few
gee,
years.
you did. Okay, so Tammy is very specific lender. I use word specific because they can do. It's not like we know no QM lenders. They're specific. They're not private money loans, or maybe it is semi-private,
Mhm.
but they can do things unusual way. And well, what's the name of your company? Pacific.
Pacific Mortgage Capital.
Exactly, Pacific Mortgage Capital. I never know the name. Yeah, and this is Pacific Bay Financial, Pacific Mortgage
Oh, I
Capital. Yeah.
know.
We're going to talk today about kind of unique product. It's called bridge loans. Bridge loans are created when somebody wants to buy a new property without selling the current owner-occupied property. Maybe not necessarily owner-occupied, can be investment as well,
Sure.
but not selling one, selling another one. And so lenders use combination of equity in both properties to qualify. And I will share with you a story which recently I had a client who wanted exactly that. Originally, they were talking about selling and then buying, but then they decided again, they found a property, they fallen in love, and this made it. We checked with one of the lenders, and they were not qualified, though they have good income. We checked with another one, and so they combined both homes. They had just to come up with about 15% down payment. Interest rate was 10 and a quarter, which is very high. Again, fortunately, they were able to qualify, and now property is closed, and now they're trying to sell the property, which is going to happen. Maybe it'll take another month. And this is what example of bridge loans. Now, tell us about your bridge loans.
Well, as you said, we offer owner-occupied bridge loans and non-owner-occupied bridge loans. The most common thing that I see in the market right now, especially in California and the Bay Area specifically, is that people have a lot of equity in their property, which that equity they're going to use for a down payment on another property.
Yes.
They're in the market, like you said, they fall in love with a property and they don't have the money for their down payment.
Yes.
Or they can't qualify for both mortgages.
Yeah.
And that's where we come in. So we take the property that they live in now currently and the property that they're going to purchase, and we combine those two values together, and we'll lend 75% of that value minus whatever outstanding liens are on the property.
All right, so let's start. So it'll go back. So what you're saying is that let's say they own a property. Let's give a specific example. A $2 million property worth $2 million.
Right.
And they have a mortgage about $1.2 million. So 800,000 is equity.
Okay.
If they'll be selling this property, they will have 800 minus sale cost of transaction. So let's say they'll end up with about 700,000.
Right. We don't really do the math that way, and the reason that we don't is because we're actually leveraging the new property, which is lien free. Okay. So by combining those two properties, if you've got $1 million property and another $1 million property and no liens, I basically can lend 100% on that.
Okay.
So
in other words, the advantage is you don't have to sell it.
That's exactly right, and it's very hard in this market. Let's just say, for instance, I do want to sell first. Where am I going to live? The rental market is very, very tight.
Yes. Okay.
So now I have to move out my furniture.
Okay.
I have to find a place to put it, and I have to find somebody that will lease me a property for a month.
Okay.
It's a very difficult situation.
Yes.
Not on top of that, even though a bridge loan is more expensive than traditional lending, at the end of the day, it becomes less expensive and way less stressful.
Okay, less stressful, I understand. Why it will be less expensive?
Well, you're not moving twice. You're not putting a lease. You're not trying to get a long-term lease. You're not stuck in that.
Okay.
So you're only moving once, one time.
So you're saving money basically this transitional period of time, which can cost unknown amounts of money
Exactly.
and a lot of headaches.
And I'm told by realtors, but by moving out of a property and staging it properly, they also get more for the house. Sometimes
Okay.
upwards of 20% more by having no personal items, dogs,
Yes.
kids, whatever, and trying to keep your house perfect while it's being shown.
Okay, so basically the institution is, and you said you lend 75%. Give me a specific example. So client needs to come up with 25% of what value?
Of the two properties. So we know this property, I'm going to run an automated valuation for that property. Also, there's no appraisals.
Okay, hold on. So what you're saying is that automatic evaluation, it means what's 1007? What's
No, it means I put this name and address into an automated value module,
Yes.
and it brings up all of the comps in the area and gives me a valuation for the property, and we rely on that.
So this is not Zillow, but something else similar to that.
Yes, it's something else proprietary to the business.
I see. Okay, so it says, okay, this property worth so much, regardless how much they're planning to list it, but you are using your own valuation.
We're using that valuation.
Okay.
They might get more, they might get less.
Okay. Okay, and then your subject property, it's again, you're not making a loan?
We're not doing an appraisal. We are doing an automated valuation.
Okay.
Those are the values I'm going to go off of.
So what happens? Okay, so, and then 25% from this combined?
From those combined.
So, but you said minus.
And then after I get my 75% of the combined value, then I'm going to reduce that loan amount by whatever outstanding liens are on their current residence.
I'll have to run numbers, and I will do it to show my clients specific numbers when they'll get after this presentation.
Okay.
Because I really want to understand. I'm a little bit confused. Even I am confused. But
well, give me a calculator.
No, we'll do it later.
Okay.
We'll do it later. I'm just saying that this is one of the questions I'll have to address, and I will send them email showing those actual numbers.
Exactly. Exactly.
Okay, very good. So what happens after you are done this transaction? It's a temporary, I guess, right?
For owner-occupied, the maximum loan amount is 11 months. It is interest only.
Okay, so within 11 months, they need to sell the property, other property.
And refinance.
Okay.
If there's a need for refinance.
Okay, so basically they're getting now new loan, and they're still responsible for the old one, or you covering the old one?
We'll go into second position, so it'll be a second on their current property.
So they're still responsible for the old one mortgage.
Yes.
They'll need to make payments on the new mortgage and the purchase.
Yes.
So okay, they have to be qualified.
Of course.
Yes. And then they will have to rush to sell the home after it's staged properly.
Exactly.
And they get more money, and then to pay off your new loan.
Right.
And then they use process from a sale if they want to. They'll buy down your new loan.
Right.
And then they'll be able to refinance and sell them new conventional loan.
That's exactly right.
Okay. Okay.
Yeah. There is an example. I'm actually, it's closing today, where a couple had no mortgage on their existing primary residence, and they were buying a brand new property, and I was able to give them cash out of the transaction to cover the mortgage payments.
Wow. All right. I want to stop here, and the reason is because when we talk to Tammy about what the company does, there's a lot of other things, and there's a lot of experience.
Yes.
And what I decided to do, I will offer you opportunity to come to my office and to have a conversation with Tammy, because we'll talk about more stuff. So we'll plan it to have a live meeting like we had it before, and Tammy and maybe somebody else will come from your company, and we'll have conversation about how can you do loans unconventional way. My name is Manny Kagan. I'm going to help you. I promise. Thank you.
Thank you.